If you're a Canadian dividend investor, then there's pretty much a 0% chance that you don't have Enbridge in some form or another in your portfolio. Enbridge is the biggest energy company in Canada and the biggest pipeline company in North America. So in this video, I don't really want to go into Enbridge as a company or talk about its operations, but I really want to focus on investing in Enbridge here and the different options you have, because you could simply own the Enbridge stock directly. The stock symbol is ENB, or you could also invest in a split share fund that exclusively holds Enbridge stock. The stock symbol for the split share fund is ENS, and it's called the E-Split Corporation. Keep in mind, guys, these are all Canadian listed stocks. So what is the difference between the two? What is a split share fund or a split corporation anyways? Also, what's the deal with the recent stock offering ENS had on August the 3rd? What is a stock offering and why did it cause ENS's stock price to go down 5 or 6% the following day? Why do fund managers actually do stock offerings in the first place? And of course, which one should you invest in, ENB or ENS? I will try to answer all those questions right now. Enbridge, we all love Enbridge, right? A dividend aristocrat here in Canada, more like a dividend king, because they continue to raise their dividend every single year, year after year for decades, I think it is now, right? So it's no surprise that dividend investors or pure income focused investors like myself have a strong interest in this stock or in this company. But gone are the days where all you could do is invest in the stock itself. Nowadays, we are spoiled for choice, as you could invest in Enbridge many ways. Besides investing in the individual stock ENB, you could also invest in a split share fund called the E-Split Fund, which came out in mid-2018 and is managed by Middlefield, one of my favorite fund managers here in Canada. So what is a split share fund anyways? I'll try to make it quick because I covered in detail in other videos. I actually have a video where I explain split share funds. Let's just do the basics here. A split share fund or a split share corporation is a publicly listed corporation set up to invest in a portfolio of stocks, typically dividend paying stocks. It's called a split because the corporation essentially offers two classes of shares instead of one: the preferred shares and the Class A shares, or the capital shares. So each class of shares, preferred or Class A or capital, have their own stock symbol, their own unique stock ticker. So ENS is the stock symbol for the Class A shares, and ENS.PR.A, like you probably guessed what the PR, is the stock symbol for the preferred share. So it's very important that when you look up ENS, you're looking at the right stock symbol. So if you see a PR in there, you're probably looking at the preferred shares. So the preferred shares, not only for the E-Split Corporation, which we're talking about in this video, but for all split share funds in general, are really the safer, the boring, and in my opinion, the useless shares. They essentially act like preferred shares in general, so they are very safe and they are stable. In a split fund, the preferred shares tend to have a very, very stable stock price that barely moves at all, and they tend to have a really set dividend yield of about 5.5%. The Class A shares, or the capital shares, in this case ENS, is where all the magic happens. The Class A shares are designed for investors who want leveraged exposure to the underlying portfolio of stocks in that corporation. So for ENS, it's super easy. There's only one stock in the portfolio, Enbridge. So the Class A shares is what gets all the capital appreciation and depreciation of basically what the Enbridge stock is doing. So I'll show you both charts in a second, but basically what this means is that if ENB, or the Enbridge stock, goes up a lot or goes down a lot, ENS will typically follow, but the ENS.PR.A, the preferred shares, on the other hand, go absolutely nowhere, no matter what Enbridge is doing. So it acts pretty much kind of like fixed income, like a bond. So back to the Class A shares now. On top of the leveraged exposure to the portfolio in the fund, which is just Enbridge, the fund manager also uses the covered call strategy, which is a zero risk income enhancing strategy to really boost the income and the yield or the dividend yield of the Class A shares. So this is why the Class A shares tend to really have a high dividend yield, much higher than the preferred shares and much higher than the just owning the Enbridge stock itself. Another important thing to consider when we're talking about split share funds here is the unit NAV, the unit net asset value, but a little bit more on that later. Let's check out those dividend yields for all three funds together right now on August 19th, 2021, right after the market closes. So it's August 19th, the market just closed, and I'm looking at ENB or Enbridge. So it ended at 47.87. So the dividend yield right now is just under 7% at 6.98 right here, because the annual dividend rate is now $3.34 a share. But if we look at ENS, which is the E-Split Corporation, so these are the Class A shares, the price is $14.15, but the yield is just over 11%, so a much bigger difference, right? Much higher than the Enbridge stock. Then if we also look at the preferred shares, so as you could see here, the stock symbol is ENS.PR.A. The stock price is 10.16, and typically for split share funds, the preferred shares are always around $10. So this translates to a yield of 5.17%. So this is why for me the preferred shares of this split fund makes no sense whatsoever. You might as well just get the Enbridge stock by itself, right? But if you really want that high yield, it's ENS that is really the interesting option here, and that's the focus of this video. All right, so now that you have a better understanding of what a split share fund is and the comparison of the yields, it's time to ask the $1 million question that I keep seeing on my YouTube channel, in my Facebook group, and I get emails all the time. Which one should I get? Enbridge or the E-Split Corporation, the Enbridge Split Fund? The honest answer, guys, is it depends on your investing goals and your personal style of investing. In the end, guys, the exposure, whether it's the Enbridge stock or the Enbridge Split Fund, the exposure is the same. It's investing in Enbridge. The only difference between ENS and ENB is how you get your return. I repeat, they have the same exposure. How you get your return is what's different. So investing in ENB or the regular Enbridge stock gives you less yield than the split fund, but you fully capture the growth and the dividend growth of the company organically, right? Whereas ENS, you sacrifice some of that share price growth or capital appreciation for more income right now. That is what the covered call strategy does and how the covered call strategy works. It sacrifices share price upside or capital growth for more income. So personally, I own only ENS because I consider myself a pure income investor. So I am willing to sacrifice share price growth for a lot more passive income. Also, I'm a bit of a pessimist at heart, so I wouldn't bet my money that Enbridge will continue to aggressively increase their dividend every year. Just because they've been doing it for the last 25 years, it doesn't mean they will do it for another 25 years, right? But if you personally feel very strongly about Enbridge, you're convinced that it will continue to grow its dividend, and you're willing to get less income now for potentially higher share prices and growing dividends, which means growing your yield throughout the years, go for the Enbridge stock. If you're a numbers guy and total return is your number one priority, then you should probably get the Enbridge stock by itself. If maximizing passive income is your number one priority, get ENS. Also keep in mind, guys, that you could invest in both. If you are constantly questioning, breaking your head, or you're generally an indecisive person, just get both. That's completely fine as well. And I know many of you watching have both as well, right? It's not a matter of good or bad, winner or loser. It really depends on your investing goals and your style. So in the end, we both have, the Enbridge stock or the split share fund. We have exposure to the same thing, Enbridge. How we get our returns is the only thing that's different. So now it's time to discuss the share offering or the overnight offering that ENS had on August the 3rd. So what is exactly a share offering? Well, like the name says, it's when the fund manager issues more or offers more shares of the fund on the open market at a certain price. So let's actually read the press release together of the share price offering. So here's the actual announcement of the press release rather, for the overnight offering. And as you could see here, they're literally saying that the Class A shares will be offered at a price of $14.50 per share to yield 10.8%, and the preferred shares will be offered at a price of $10. They're usually always $10 to yield 5.3%. So it's called an overnight offerings. You could see a treasury offering, and when a split share fund does this, they have to do it for both the Class A shares and the preferred shares. So once again, Class A shares were, they were issued, or the offering was $14.50 per share, and that's the Class A shares, and the preferred shares were $10 per share. So what exactly happened to the stock price? So if we look at the actual stock price, guys, on August the 3rd, you could see that it closed at about $14.90, and then the following day, right after the announcement, the fund went down to $14.02. So that's about a 5 to 6% drop. So what essentially happens, guys, is that a big number of shares are created and flood the market the day after the offering is announced. So the supply of shares on the open market drastically increases. And of course, we all know what happens to prices when supply shoots up. Prices go down, right? So this case was no different. Like we saw, ENS stock was about $14.90 on August 3rd, and the following day it went down 5 to 6% at about $14. So this is economics 101, guys, the law of supply and demand. This is why the day after, the share price of any fund that does a share price offering always takes a hit, usually 5%. This is expected, completely normal, and shouldn't make you panic. Why? Because we are buy and hold income investors, guys. We don't intend to sell any shares. We just collect the income every single month. So why would we care if the stock price temporarily goes down for 1 or 2 days? I certainly don't care. On the contrary, this should be seen as a buying opportunity, not a bad thing. It's a very easy way to get more shares the following day after an offering at a much cheaper price. So this is why whenever I spot an overnight offering, I let you guys know about it either via a community post on my YouTube channel. It's really not hard to spot one because the stock usually halts trading when the offering is announced, right? And trading resumes the following day. Nothing to worry about, guys. So make sure you're subscribed to my channel to get alerted for these overnight offerings. I might not catch all of them, but if you're subscribed and also you join my Facebook group, there's a good chance that you will be alerted in time. This one was no different because a couple of people, put the post there even before I got to it. So if you miss it, don't worry about it, guys. No big deal. So why do fund managers do this? Why do they issue more shares? Well, I can answer that easily enough, even though I haven't officially validated this information. So I'm giving you my opinion here, but I'm pretty confident I know the reason. Fund managers make all their money with management fees. So more shares, more fees for them. Duh, right? So this explains the why, but what about the timing of it? What makes them decide when to do an offering? Well, after years of owning these types of funds and seeing multiple overnight offers, I'm pretty sure I know what the answer is as well. It all comes down to the fund's NAV price versus the fund's stock price, which I've been talking a lot lately on my stock picks of the month videos. So in case you didn't know, every single fund, whether it's an ETF, a closed-end fund, a split share fund, doesn't matter. They all have a NAV price, a net asset value, and they have their stock price, right? That's the price you see when you look up the ticker on whatever website you use. So stock price is what the fund is currently trading for on the open market. So when you look it up on Google or whatever, that's the stock price. The NAV price is different. It's what one share of the actual fund is actually worth. So NAV stands for net asset value, the actual value of the share. So how do you find this info? How do you determine what the NAV of an actual fund is? Well, you need to find it on the fund's website. So let's check out the NAV price for ENS in question that we're talking about here real quick. So I'm on the official homepage of the fund, the E-Split fund, right on Middlefield's homepage. And if you click on this tab right here, NAV, which stands for net asset value, you could actually see the breakdown of the NAV for both the preferred share and the Class A share. So the preferred share is $10.07. It's always around $10, not really interesting. But the Class A share, as you could see, as of August 18th, which is from yesterday, the NAV is $13.17. Now, the unit NAV is 1317 plus 1007. It's the combination of the Class A NAV and the preferred share. That's why it's called a unit, because two together they make a unit. So as you could see for ENS, guys, the current stock price is currently much higher than the NAV price. The current stock price today on August 19th is a little over $14. And as we saw, the unit NAV the NAV was lower for the Class A shares. This means that the fund is trading at a premium. The fact that the stock price is higher than the actual value of the share is what motivates fund managers to pull the trigger and do the offering, because they are getting a good deal, right? Like we saw in the press release, they issued the shares at $14.50, where the NAV was less than $14.50. So they get to issue shares at a higher price than the fund is actually worth, because demand is high. It's like everything else in life, guys. Demand for real estate, right, is really high right now, and houses are selling for more than they're actually worth. They're selling at a premium. The value of something is based on supply and demand and nothing else. So the seller has the advantage when things are selling at a premium, and the same goes for stocks, guys. As simple as that. So did you learn anything from this video, guys? Please, if you did, please hit that like button, that thumbs up button. I would really appreciate it. It's free for you. It helps the channel grow, so it's a win-win. Also, I do realize that I haven't really dug deep into split share funds and how they work and all that, but keep in mind I have a YouTube playlist dedicated to split share funds. So if you want to know more about these products, keep in mind that they are exclusively Canadian products. There's no funds on the US market that are called split funds. I get a lot of questions from Americans all the time. How come I can't find split funds on the American market? Well, keep in mind that split funds are essentially covered call ETFs with leverage. So on the US market, they might not be called split funds, but there's a lot of nice closed-end funds that are leveraged and that use the covered call strategy. So in addition, guys, make sure to check out my website, passiveincomeinvesting.ca. That's where you could access and purchase my digital product that I'm very proud of, and I know many of you love it because I keep getting comments that it's great. It's called the Ultimate Dividend Passive Income Investing Package, which is all my years of research to outline the best funds for growth and income for both Canadians and Americans. There's samples in there, sample portfolios in there to get you started. It's really a tool to help you build your own portfolio. So I'm on version 2 right now. Version 3 is going to come out soon, so make sure to pick it up because it comes with lifetime updates. So you only need to buy it once to get the future updated versions. Also on my website, you could book a one-on-one video consultation with me personally. I do meetings via Zoom. Unfortunately, I'm completely booked up right now until October, so I'll let you guys know when the October appointments will be open. I appreciate your patience. I keep getting over and over, at least daily requests to squeeze me in. Let me know for any cancellations. I'm doing my best, but right now I'm completely full, guys. So hang tight. October appointments will be open shortly, and I try my best to have the most appointment slots available. Finally, make sure you're subscribed, guys, if you're not already subscribed. If you like this type of content, my channel really focuses on investing in the stock market with the primary objective of passive income, but I also discuss other various investing topics as well. We're also on social media. We're on Instagram. Join us there if you use that, especially you younger people. And we have a Facebook group that's growing almost at 2,500 members, a nice little community there. You could ask your questions, show your portfolio to get different opinions on it. People respond right away. It's really, really awesome. Phenomenal people there. I'm really happy about how the group is going, how the community is progressing. My mission of the channel is always the same, guys. It's to help everyday normal people invest on their own in order to build their own stream of passive income to enhance your quality of life. So with that, take care, guys. Stay safe. Get that double jab as soon as possible, and see you next time.